Hello there, I'm Eric Peckham, and this is the Monetizing Media podcast. As with my Monetizing Media newsletter, my goal is to dissect business opportunities across the media, entertainment, and gaming sector. I'm joined by a leading entrepreneur, executive, or investor in each episode as we dig into a case study on their company, an investment thesis they have, or other tactical insights on business models, pricing, and creating loyal fans. Today I'm discussing content financing in the entertainment industry with my friend Andrew Kotliar. Andrew is the founding partner of MEP Capital in New York, a firm that provides debt and equity financing to support IP projects and company growth within entertainment. The firm currently has 25 investments with an average check size of $5 million. Andrew, excited to chat today.
Nice to chat, Eric. Thanks for having me.
Absolutely. I'm excited to dive in on the type of investing that you and your team are doing. On past episodes here, we've gotten the perspective of venture capitalists focused on tech startups within the entertainment space, on a firm doing documentary financing. So I think the perspective you bring in terms of both being pan-industry, but also looking at a particular set of companies and types of content projects to finance will be interesting to highlight.
Absolutely. Would love to give you and your listeners some color. Really enjoy the podcast.
I know a lot has changed in the last few months in your business and the industry in general because of the pandemic. But I'd love to start, before we get into the impact that has had, by framing a little bit of what your firm has been up to. So give us a basic description of your firm's investment strategy and how that's different from some other players in the space.
Sure, absolutely. You really hit the nail on the head in terms of the breadth of what we do. Fundamentally, MEP Capital, we either acquire or provide financing to projects and assets really across the broadly defined media and entertainment industry. And our primary focus is on situations that may, for whatever reason, be underserved by other sources of capital. We really cast a pretty wide net in terms of operating across different types of media formats. We do a lot in music, film, television, digital media, print publishing, obviously until very recently live events. And from a geographical focus, we don't have any restrictions as well, just by nature of where we are. Most of our time is spent in US and Canada, but we also spend a decent amount of time in Europe, including the UK, as well as Australia. We can acquire assets outright, whether it's music catalogs or film libraries. But a lot of what we end up spending our time on is much more custom tailored solutions that help owners of copyrights or owners of valuable IP unlock capital, whether it's for offense or for defense in certain cases, without needing to sell their rights, without needing to dilute their ownership of their businesses. For us, it matters less whether the market is a certain number of billions of dollars or that your month-over-month growth is X versus Y. We're very happy to work with businesses and assets that are small or mid-sized and that are happy to stay small and mid-sized, as long as obviously there's either potential for profitability or already a demonstrable track record of profitability and cash flows.
Are you able to give a few examples of some recent deals to highlight the different structures that your firm is investing in? I know one of the recent ones that we've talked about before is you're providing financing for a new film that's kind of a modern take on Oliver Twist.
Yeah, so I give a couple of examples. We can start with that one, which is called Twist. Film financing and television financing represents usually about a quarter to a third of our annual activity. And this is a good example. We're providing the majority of the financing for the production of exactly, as you described, a modern take on the classic Oliver Twist. The film is starring a very high caliber cast: Michael Caine, Lena Headey from Game of Thrones. The musician Rita Ora has a prominent role. This film is in final stages of production out of London and will be released by Sky, which is now a division of Comcast, obviously, later this year or early 2021. Another example in the music space is the financing we've provided against a set of rights of several prominent hip-hop artists. These rights are currently owned by a larger diversified media company. And what raising this financing allowed this company to do is access liquidity for unrelated growth initiatives, more on the film, television, digital media side, away from music, without having to sell those valuable music rights. And that deal looks more like a traditional debt type instrument versus
Hmm.
equity, but definitely with much more flexibility than if they were to go to a bank or another type of credit provider. And last quick example, just to show a different side of things on the digital media side, we work with a network of special interest YouTube channels that generate somewhere around 2 billion views per year. And there, it's a very custom deal. It's neither debt nor equity. It's a revenue share type model where if they're having a great year, we'll have a great year. And if conversely something changes, for example, the pandemic, things will be different, and that's okay.
Gotcha. And looking at the last few years before the pandemic hit, which types of deals was the firm most focused on pursuing?
Yeah, it's always been broad. We've never pigeonholed ourselves into just one subsegment of the industry. But in terms of where the opportunities were probably most lucrative on a relative basis, certainly in film finance, in terms of lending and providing capital against certain jurisdictional tax credits, as well as licensing deals. In the music space, the best opportunities have definitely been in the what I call the nichier, darker corners of the industry. So maybe not the most iconic household name artist catalog that everybody will have heard of, but something a little bit more industrial. Maybe it's instrumental music, maybe it's music that goes into background of TV shows. Not as sexy, but definitely some interesting opportunities up there. And generally, zooming out across the different types of media formats, the big trend has been financing acquisitions of different IP assets. Company A is buying a bunch of rights from Company B and needs quick and flexible financing for that. So we've done a lot of stuff helping folks buy rights in order to grow.
Has it been a particular deal from these last few years that's been an outlier in terms of the returns it's generated?
Yeah, I mean, look, as we were discussing, we're not in that hyper growth hockey stick, home run type business. So we never really bet that one deal is going to make a very outsized return. But I'll give an example of something that's worked out very well for us and frankly worked out well for everybody involved. The company is a duo of composers who work with major television networks globally. And what they do is provide music primarily for reality TV shows like Family Feud, Shark Tank, MasterChef. So these composers, the founders who've grown this business organically over the last 10, 15 years, we've allowed them to free up some capital for themselves without needing to sell the business. And we've also allowed them to unlock capital to invest back into the business to pursue new growth initiatives, in particular on providing music to the scripted content universe, which is also a growth area. And ultimately, what happened is as they've grown and attracted more industry attention and expanded their horizons, they got on the radar of one of the larger guys, and they ended up deciding to an M&A transaction with one of the larger music publishing houses. And that ended up being a pretty attractive outcome for us.
Yeah. I'm curious with financing the acquisition of a catalog, or in this case, financing a company to maintain their own catalog and not have to sell it. How, aside from kind of a basic financial analysis of what the past royalty stream has been, how much are you looking at those opportunities from the perspective of what the current owner or the new owner can do beyond just what's currently been done with the catalog in terms of helping get more sync licenses where the music appears in more films and
Mhm.
commercials, or does
Yeah.
something else to make the music even more popular than it has been?
Yeah, it's a really great question, and the answer depends on the type of deal it is, and ultimately what the valuation is, or position in the capital structure. If we're providing equity, valuation matters a lot more, and the growth profile of the acquirer and what they're going to be able to do with the asset matters a lot more. If we're providing debt, maybe that matters a little bit less, assuming there's significant cushion. In certain cases, we really need the buyer to be more proactive with active licensing. That sometimes is a crucial part of the thesis. And so we need to spend a lot more time understanding are these the right folks to be able to do that relative to whoever owned it in the past. And in some cases, the deal setup is such that we're just very happy for the asset to continue doing what it has been doing without the need for more growth.
Mhm.
And frankly, the new buyer should take the vast majority of the spoils of any new growth that they're able to bring to the table.
Gotcha. I'm curious how you focus on mitigating risk when backing new IP, and kind of particularly outside of music, where you can look at the royalties a catalog has been generating the last few years. But thinking about financing a film or a new digital media project, how do you look at mitigating risk with new IP like that? Does it have to be based on some prior IP or involve someone who has a large fan base?
So for us, any financing we do that relates to new, let's call it unproven, for lack of a better word, IP, it really needs to come with some level of risk mitigation mechanism. So in film, for example, where it's notoriously difficult to predict box office or predict ultimate outcomes, even in this world where everybody thinks that they'll be able to sell their, show or film to a Netflix or a Hulu of the world. For us, we rely heavily on being able to pre-sell certain territory rights, as well as monetizing tax credits that are earned by producing in certain jurisdictions. A lot of times, these two mechanisms, the kind of pre-licensing model, where you get a minimum guarantee from a distributor, sometimes domestically, sometimes internationally, that gives a lot of visibility when layered with the tax credit monetization. So film has a pretty defined playbook. It's not that novel of a concept. And in other media types, and especially in situations where those types of models, like in film, are not available, we really like what I call bifurcated situations where a company or a producer or a network of some sort on the digital side, they really want to invest in new growth initiatives, but they're also sitting on some kind of library of past IP, doesn't matter whether it's music, film, YouTube channels, podcast episodes, whatever it is. And we can look to the old stuff as our worst case scenario, and based on that, invest in the new stuff.
Gotcha. I'm curious on the film financing side, does pre-selling foreign distribution rights in certain markets create any challenges if the team then does want to go and sell that film or show to a Netflix that wants global distribution? Or if it
Yeah.
gets to that point, it tends to get worked out?
So those situations definitely come up, and that's a very natural push and pull with producers when discussing what the right financing plan looks like. Different projects attract different type of appetite from distributors, and that's something that we feel can be tested in advance. It takes a little bit more hand-holding of the various agents, both foreign as well as domestic, to really ascertain, hey, is this a project that realistically will get global Netflix or Amazon or something like that deal?
Mhm.
Or is the better path, with speed in mind, to go ahead and sell a bunch of foreign rights to more traditional distributors in those geographies, use that base to create a proper financing plan for someone like ourselves, and go to market quicker? And oftentimes the decision does really come down to time, because especially in the independent sector, when you want to get a great director or a great actress or actor attached to your project, you don't have a very wide window of time to deliberate this type of deal or that type of deal, because they're in demand. They're flying around the world, obviously pre-COVID, doing much bigger budgets for studios, for networks. So if you want to be able to pounce on a Bruce Willis or somebody of a high caliber that's attractive to the foreign market, you got to make decisions relatively quickly. And so those types of tensions definitely do arise, and it's a very fair discussion to be had. We've also been in situations where rights on the foreign side have been sold only later to get an offer from, let's call it, a more global buyer who may want all of the different rights. And then you do need to go through the unpleasant exercise of knocking on the door of the Turkish distributor and the German distributor and saying, hey, we'd really like to buy back the rights because we're going to flip it to Netflix. It's important to have the right agents involved and to do it all with tact. Everybody hears in for the long term, and there's going to be a project after, and you don't want to burn any bridges. So it's always requires a decent amount of judgment.
Gotcha. And I'm curious on the podcast um, side, has that been a space that has heated up a lot in terms of financing opportunities, and particularly when your firm has an average check size of 5
Mm-hmm.
million?
Yeah, podcasting is a fascinating space for us for a number of different reasons. Number one, we very strongly believe in them, and the fact that the advertising floodgates are yet to open, and they will, and the format will change, and the monetization will change, and the technology will change. That's happening, but I think we're still in the early innings, as several of your past guests have said as well. I think from an investment perspective, the hardest part about podcasting is finding enough scale to be able to deploy sufficient dollars that move the needle for a fund of our size. We have found it very effective to work, which at least try to work with different types of aggregators. Maybe it's a smaller network, maybe it's some kind of a service provider, maybe it's a management company that oversees different types of properties, to try to pool together a couple of different titles and create financing structures around those. It's diversified, and that makes it easier to invest because you're not making decisions on individual $50,000, $75,000 checks, which we unfortunately are not able to do.
Yeah. Well, I really want to dig into the impact that COVID has had on the industry, because obviously it's kind of come through like a freight train the last few months and had a dramatic impact on every part of the entertainment sector. In some places, a positive one for business, and in many cases negative. Starting at a high level, what's the fundamental realignment, if any, that you're seeing in terms of who is doing deals or isn't doing deals right now?
Yeah, so my view is really what's getting squeezed is the middle. The large buyers, organizations, studios, networks with large balance sheets, they are able to withstand a lot of pain. They're able to be very opportunistic as things come up and pounce on those situations. And they're also able to invest for the long term and sacrifice near term earnings. The bottom tier, where there are a bunch of niche players, maybe they're focused on genres or maybe they're focused on geographies, they've always recession proofed their businesses to a certain extent, obviously with some exceptions, because of this high degree of specialization. And if you sort of stay very small, very focused, very specialized in the media space, you can have a nice profitable business if you're not kind of dreaming of taking over the world. And so those businesses we feel are also okay. And again, that spans both film, television, music, book publishing. The middle tier is really where we think there's going to be most shakeout. There have been a lot of organizations that have been founded positioning themselves as mini majors or the equivalent to the next major music record label company or the equivalent to the next big news organization, but in the digital space. And in the grand scheme of things, these are mid-sized companies that are sort of neither here nor there. They're diversified, and so they're not very focused on any one thing. They don't have the balance sheet that's truly required to withstand the type of crisis that we're going through right now across the space. So that's where we see most trouble on the horizon.
Yeah, I'm curious on the film financing side. Obviously, production has been shut down in many countries, is starting to open back up in some places. How has this impacted your willingness to do any new film financing deals or the type of opportunities that are rising there?
Yeah, I mean, look, everybody's getting itchy to get back into production. The biggest challenges are really around things like insurance and completion guarantees, which independent producers, as well as any banks that finance productions, absolutely require. There's a lot of uncertainty around how terms of those insurance contracts and completion guarantee contracts will need to adapt. In certain jurisdictions, there have been recent announcements of governments stepping in a way to backstop some of these processes. But as always, when dealing with governments, there's usually kind of a shiny press release, but the details are a little bit murkier. On the economic side of actually making profit on film deals, all of the obvious dislocations around the theatrical window are extremely consequential, especially in geographies that are still very heavily reliant on the theatrical window. So places like Latin America, places like China, places like Middle East. Of course, there's a burgeoning streaming and video on demand market for monetization, but for a lot of types of titles, you still need that theatrical window to be able to make the math work. And without some of these larger territories, some of these financing plans for films just start to fall apart very, very quickly. So that has been a challenge for us in terms of rushing back into the space. Our focus is definitely in the film and television space for now. Is cautiously optimistic. We are working on a couple of situations where we're able to help folks finish products, finish production that was started maybe pre-COVID, maybe got interrupted, and just needs additional capital for VFX or for editing type, post-production lab type work. Those opportunities are interesting. In terms of ramping up new production financing, we are currently not in a rush, but are definitely evaluating the situation, especially when it comes to the insurance side of things.
Yeah. I'm curious on the live entertainment side, whether it's concerts or theater or comedy shows. Obviously, it's been the hardest hit just because in many places they're literally outlawed from gathering that many people
Yeah.
in a venue. I'm curious, to what extent do you view this as a time to just stay out of that market versus as an investor, there's opportunity there because everything is struggling and heavily discounted. And if things return to normal, it'll be a
Yeah.
great deal later.
Yeah, it's something we think about a lot, and we did do a decent amount of live event, primarily concert financing prior to the pandemic, and that was a very lucrative business, and there seemed to be insatiable demand.
And concert
Obviously,
financing, when you say there, is kind of putting up the money upfront, the advance to secure the venue, to secure the artist, that type of stuff.
exactly. Secure the artist, secure the venue, provide capital for marketing of the events. And every show is a little bit different. And if you work with the right partner, there's a playbook for the right and the wrong way to do it. Right now, the playbook is a little bit irrelevant. But there's no question in most industry participants' minds that the demand is not going to change. And the one metric that Live Nation, just as the industry bellwether, keeps reiterating in their press releases and earnings reports is that roughly 90% of folks who have bought a ticket prior to COVID are not asking for their money back. They're hanging on to it to an indefinite, time in the future. And the narrative is that if you really thought there was a demand issue, if people really thought that this is different and we don't want to be near people and social activities anymore, they would ask for their money back, but they're not. So we tend to agree with that, obviously, with certain exceptions. From an investment opportunity, the last thing you want to do is get the timing really wrong and pretend your knowledge of vaccine science is better than the experts. So some folks are very happy to take a market timing bet where they say, look, we have a strong view that by summer 2021, things will reopen. Therefore, if we can finance this music festival that is set for, I'm making it up, July 2021, if we get it right, we're going to win big. If we get it wrong, who the hell knows, right? You can also participate in some of the ancillary rights and components by, in the Broadway space, participating in merchandising revenue or music revenue related to certain productions. And then you can also associate yourself as an investor with long-standing organizations where you can take the view that we'll invest today and we'll just wait it out. It's not about one particular event. It's about a brand. It's about legacy value or scarcity value. For us personally, we are not the market timing types, so that really isn't what we do. Even though the potential upside, if you get it right, can be substantial. So we are working with folks that we worked with previously who have a long-standing track record, more in the weighted out category. And then we're also experimenting with ancillary revenue streams around the live event space, whether it's a service provider or events that are pandemic compliant. For example, we're looking at a Christmas lights show, right, which is done through sitting in your car and driving through, certain part of town, and you pay for that. We'll see. But those types of things are interesting because you have the combination of a visible demand, but some of these workarounds to the logistical dislocations.
Yeah, I'd love to pose a hypothetical to you to better understand how you are looking at the market right now of where there is opportunity. If your firm had, say, an extra 500 million to invest this year, that many more resources and had to be invested within the next 12 months, where would you focus it? Are there clear areas of opportunity right now popping up?
Absolutely. I mean, look, there are a couple of secular themes that are running through the media and entertainment space where capital is one of the bottlenecks. And if we had an extra $500 million to spend, it's not a big challenge to spend that in a smart way, obviously. But one of the biggest themes that's been resonating across the industry, whether it's film, TV, or music, or book publishing, or whatever it is just the strive for independence by creators. You're increasingly thinking about, when did I give up my rights to somebody else? When did I license something out because I needed to? When did I sign that record label deal? When did I enter into an output agreement or a JV structure with one of the studios? When I was younger, when my business was not as, successful, when the market was different, and what can I do to get that back? Because I no longer need somebody else to handhold me through distribution. And if I'm continuing to put out IP that resonates with audiences, why am I not seeing the benefit of that? And why am I not owning all of the stuff that I've done historically?
Yeah.
And so that theme is very, very prominent right now. And look, you see this flare up into some things that become controversies, like some of the stuff around Taylor Swift that's been out in the news. But there's always a flip side to that, right? So that is a big area of focus for us already. And that's a decent amount of what we do, is working with folks to buy back their rights, or at least try to negotiate buying back their rights. You need to be able to kind of put up or shut up. So capital availability and capital security is important there. So that's one very, very big trend that we're seeing, that we are excited to put more capital to work in. But the other one I'd mention, more on the digital and new media front. We've alluded to some of these things in our conversation earlier. But while there's already been a bunch of consolidation, both from a position of offense as well as from a position of defense in the digital media space with digital publishing and stuff like that, we think that's still phase one of more to come, in addition to more just general kind of sophistication around the digital media space. We talked about the potential for the podcasting space to grow up by better advertising technology and all of the other stuff that folks that listen to your podcast know about. But we expect a lot of deal making activity in podcasting, in digital publishing, in YouTube or short form content related areas, news publications. A lot of that has happened, but nobody has built it to a point of true scale that matters. And so there's going to continue to be dislocation, both good and bad, on that front, especially as some of the venture capital community continues to retrench from the media space, or at least the version 1.0 of the digital media space. And then lastly, a little bit more of our bread and butter, but there's a lot to do there on just financing music and film library acquisitions. There are a lot of people in the space right now chasing music royalty and film royalty deals. We're usually not the most aggressive buyer of some of these things, just in terms of the valuations that people are willing to pay, that we're not. But from a financing perspective, by providing debt or equity capital to help other people express a very kind of bullish view, there's a lot of that going around. And frankly, not everybody who's in the market making purchasing decisions, they don't always have capital lined up. And sometimes we find opportunities where we're really the capital behind the scenes of some of the transactions that are reported out in the media. And there's a lot more to do in that space as well.
Yeah, gotcha. Well, Andrew, thanks so much for walking us through your business.
Eric, it's been a pleasure. Thanks for all the thoughtful questions.
Thanks for listening to the Monetizing Media podcast. To keep learning more tactical insights on the media, entertainment, and gaming industry, subscribe to my Monetizing Media newsletter at monetizingmedia.com.